That's right, we have seen a very sharp pickup in volatility recently in the FX market. To us, this mainly reflects the renewed uncertainty over the emergence of the new COVID variant. That's made investors more uncertain over the outlook for global growth next year. And we have seen a brief period of risk aversion come back into markets, which has helped to benefit the more traditional safe haven currencies such as the yen, Swiss franc and euro. Those have outperformed over the last couple of weeks. But we think over the next couple of weeks we should get more clarity over the likely impact of this new variant on global growth. Until then, the situation remains very uncertain and should keep volatility high in markets. But our assumption at this stage is that we think the variant will likely slow global growth next year during the first half. But we don't think it's going to be sufficiently bad to derail the global recovery. So we should start to see, as we go through next year, investors starting to take more risk on again. Well, I think it makes life more challenging for central banks. On the one hand, the new variant is likely to disrupt growth and slow the recovery through the first half of next year, which is certainly a more bearish development for central banks. But on the other hand, it's likely to prolong the period of disruption to supply chains globally. So it could mean that we have more persistently high inflation pressures. So central banks are going to have to weigh up the pros and cons of slower growth against higher inflation. And as we've seen already, it's already starting to lead to some mixed reactions among central banks. So firstly, we heard from the Fed last week, and the message from the Fed to us was very hawkish. They signaled that they're losing patience with higher inflation and that they're going to speed up the pace of tightening going forward. As a result, we now expect the Fed to double the pace of their QE tapering plan this month, and then that potentially will bring their QE program to an end in the first quarter of next year, and will open up the possibility of multiple Fed rate hikes in 2022. In contrast, we heard from the Bank of England last week as well, MPC member Michael Saunders. He was one of the more hawkish Bank of England members, voting for a rate hike in November. But as a result of the new COVID uncertainty, he's now more uncertain over the need for an immediate rate hike this month. So to us, the risks are now tilted firmly in favour of the Bank of England delaying the decision to raise rates again this month, and that we think it's more likely now they'll raise in February of next year. So for the FX market, we think that's important. It will narrow the gap between the timing of the first Fed rate hike and the first Bank of England rate hike, and will help to keep downward pressure on cable as that moves closer to the 130 level. And then finally, in the next couple of weeks, we also have the ECB will be giving their latest policy update. They're expected to announce plans for their QE program for next year. But because of this new COVID uncertainty, we think they may delay releasing those full QE tapering plans until at least maybe February of next year. Just because of the uncertainty, that means that they'll be more cautious about committing to tapering plans at this point in time. For the FX market, I don't think that means a great deal. We still think ultimately that the euro will remain in a bearish trend against the dollar as we head into next year.